Our next speaker is Dave Shuey. He is the CEO of a $55 million asset Financial Partners in it's FCU in Woodburn, Indiana. They also serve residents in Allen, Adams, and DeKalb counties in Northeastern Indiana. He lives in Berne, Indiana, which is about 50 minutes south of Woodburn, with his wife, Lona, and his 11-year-old son, Brandon. He was raised on a crop and livestock farm with 4 older brothers just north of Springfield, Ohio. And they raised cattle, pigs, and showed them at the Clark County Fair. He graduated from Northeastern Clark High School and went to the Ohio State University and received a BS in Ag Education, Cooperative Extension Work, and Animal Science. After working in the ag retail industry with Tractor Supply Company for 2 years, he went back to OSU to get his MS in Ag Education and Ag Communications. While he was there, he obtained his license to teach vocational ag science, and agricultural finance at the high school level. After 2 years of his teaching stint, his career path took him into banking. He started his banking career in 1995 with Security National Bank, now Park National Bank in Springfield, Ohio. He started as a teller and worked his way through the ranks to bank officer, lending and compliance position at the main office. And now it says through his stops as a branch manager in South Charleston and Enon, Ohio, he became proficient in agriculture and commercial lending to go with his experience in retail, which was personal, auto, real estate lending. Then he transitioned to the credit union industry in 2006, where he was a business development officer for a credit union in Marion, Ohio, where he was responsible for bringing in new business clients for commercial lending opportunities. In 2008, his wife and he were married. And not long after that, in 2010, he took his current job as the CEO at Financial Partners FCU. How'd I do, Dave?
You did all right. Sorry for that. I didn't know how to shorten that any, so sorry about that.
No worries. We're glad to know all about you, Dave. So
All
now
right.
we're ready to hear your presentation. Thank you.
All right. Well, thank you very much, Tia. Thank you, everyone, for having me here. Wanted to touch base with everyone today on, especially from a bank and credit union perspective. I know Kurt and Marcus shared some very valuable information for everyone, but from a bank and credit union perspective, there's really not much difference between both entities, but there are some differences in the lending process. We're going to look at underwriting guidelines. What do financial institutions look at in extending credit? And you heard a little bit of it from both Marcus and Kurt on character, capacity, and capital, and our FICO scores, what we look at in a game plan, collateral, why is it needed, different types of loan structures and terms. And my contact information will be at the end of the slides once we get the slides up. Banks and credit unions, differences in lending. As I said, there's virtually no difference between banks and credit unions and how they review an application for a loan. Where they may have different thresholds, they still evaluate their loans on three main areas: character, capacity, and capital. The main difference with banks and credit unions is their structure. A little bit about the differences there. Banks are not geographically restricted like most credit unions are. There's some larger credit unions that are nationwide, but our credit union in Northeast Indiana has those 3 counties. That's how we're geographically restricted in those areas. Banks have stockholders and a paid board that are responsible for the decisions made. Credit unions are not controlled by any stock. Each member in bank terms, that would be a customer, has an equal say in the direction of the credit union, no matter how much they have deposited. And a credit union's board of directors is totally volunteer with some exceptions for training and travel expense. That's basically the difference between banks and credit unions, but from a lending perspective, an underwriting perspective, we're basically the same. Now, I wanted to get into talking about, in our case, I Kurt mentioned the 5 C's. They go a little further than we do. We look at the 3 main C's of character, capital, and capacity, and credit. Character is basically in the financial world is about credit and game plan. Financial institutions will first review your credit report. Within the credit report, there's a score called the FICO score. The score is divided into areas where there's a chart. Once we get the screen up, I could share the chart with you. But the chart, oh, there it is. There we go. Great. Okay. And you can see right there, you can see the chart there. 35% is payment history. Basically, are you paying on time? Then as far as balances owed, 30%, how much is too much? And within that, I always tell our members that come in and see us for loans, I tell my loan officers this, that you watch what we call revolving debt. The revolving debt is basically your credit card debt. You don't want to use more than 35% of your revolving debt. Because if you do, then your score starts coming down. Length of credit history, that's 15%. Are you a new borrower? Ideally, you don't want to, ideally, you're going to want to have at least what we call 3 open trade lines in your credit report. And what I mean by 3 open trade lines, it's basically 3 open credits, whether it be whatever, doesn't matter what type of credit. Could be a personal loan, could be a credit card, could be a mix. But those should be open 18 to 24 months usually. Again, there's some exceptions based on who you deal with, but that's what they talk about with the length of credit history. New credit. We look at new credit being 10% of that, and how many balances have you created? You don't want to create too many balances at too quick of a time. That can tend to drop your score down a little bit as well. And credit mix, what types of loans, open-ended versus closed-ended? We'll get into that a little bit later, but different mixes of loans, that's always a good thing. And then also too, on the back end, while they don't mention in here, the amount of inquiries on your credit bureau can affect it. 1 to 2 points per what we call a hard pull. So those are some things you can consider when looking at character and as far as the credit, but then also too, with the character side of it, the game plan. And that'll be our next slide. The game plan will be, it is a part of capacity, but it's part of your business plan and financials. They're a part of capacity, but the fact that you come to a meeting with a banker prepared goes to the character equation as well. There we go. Yeah, I know it was mentioned before here, we talked about business plans and make sure they are as complete as possible. Even as a startup, you're still going to want to have a plan when you go in to your financial institution. Your financial institution, you want to be prepared when you go in. Business plans are usually going to be more detailed as you first start your farm enterprise, because they are your game plan or blueprint for what you need to do. And you saw some of Kurt's and Marcus's information, but they have USDA.gov has excellent materials on beginning farm enterprises. And if you're looking for a template, a good template to use for business plans, what we call Form Swift. has it. And then I got their link down there for you to look at it there. So next slide. Underwriting guidelines capacity. And this is the second layer. In the banking world, is just simply the ability to repay any type of loan. For personal loans, it's a debt ratio, and for commercial loans, it's a coverage ratio. I know Marcus, kind of at the end of his, talked a little bit about his ratios that he looks at, and then I'll talk a little bit about how we interpret it in the banking world. For a bank or credit union to determine your capacity, they'll need to see your sources of income, depending upon the amount borrowed and the type of loan, 2 years of tax returns, and a personal business financial statement will also be needed. And then, as he mentioned, I believe Kurt mentioned that you'll have off-farm, some will have off-farm income. So then a lot of banks and credit unions will then want to see that W-2 income and pay stubs from another job. For well-established farm enterprises, it may be able to finance itself. You know, the farmer would simply sign on the loan personally as a business owner, and then there will be a business financial statement that would need to be on file. Put a note down there: in evaluating standalone enterprises, financial institutions will look at what we call the coverage ratio. This is what was talked about earlier. An applicant's outputs revenue should be 1.5 times or higher than their inputs expenses. This ratio would include the loan repayment. And I always give an example there. I don't have it listed there, but yeah, I know I heard Kurt give a couple examples, but I think of a sweet corn enterprise that I had in the FFA when I was in high school. I had to make sure that I kept all my receipts and kept everything I had, because then I looked at, I sold it to local stores, and I also sold it on a roadside stand as well. But then I also had to keep track of my inputs with fertilizer, with seed, things like that. Lenders want to see that. So go ahead and go to the next slide. With many small businesses and farm operations, there's a need for the owner or sole proprietor to work outside of the business to help subsidize enterprise, as I said before. And in those cases, a lender may use the personal evaluation for debt service called debt to income ratio. The standard most financial institutions use is for no more than 36 to 40% of the borrower's total gross income be leveraged for debt. Our credit uses an estimated net income at 45 to 50%. So there's a little bit difference. We use, instead of the gross, we use the net, but then we basically, that's a little bit higher figure on the net side. After proof of income attained, that figure is discounted 25% to estimate the total net income. You can see the example there at the bottom I gave. And I did, in this slide here, I did discover I made an arithmetic error. We look down here, total gross income 50 with total gross DTI should be 1,000 divided by 5,000, which is equal to your 25%. Then you have your net income down at the bottom, and figuring that out, just discounting that to 75% is $1,337.50. That gives you a net DTI of 37.5%. So that's what banks and credit unions look at from the personal underwriting side. Next slide. One final thing that lenders will evaluate in determining capacity is a borrower's discretionary income. Discretionary income is defined as money that's left over after the monthly debts are paid to cover family expenses such as food, insurance, clothing, and entertainment. I know Marcus in his talk, his ratios left that into the overall valuation. When we look at it when we look at the bottom figure, we take into account that money left over if we're looking at that, and then we make the decision based on how much is left over. And both a standalone enterprise and non-standalone enterprise, financial institutions will use a measure of $1,200 to $1,500 per month left over on a DI. You can see what that equates to. And again, keep in mind that these guidelines for capacity, these are just general bookmarks or benchmarks, and are variable based on the loan request and size. Next page. Capital. Basically, capital is what is your collateral. I know it was talked about, Kurt talked about a little bit of that earlier, but these are the items that the borrower currently owns that have monetary value that can be pledged as collateral. If a lender wants to know, a lender will want to know if you have valuable assets such as real estate, personal property, investments, or savings, which to repay the debt if the income is unavailable. From a farming perspective and other commercial operations, inventory, accounts receivable, and supplies may be used as collateral. Those items must be listed on any type of income statement. And I believe Marcus talked about your profits and loss statements and balance sheets. And those are always supplied to the lender at the time of the application. Most lenders will, again, there's going to be some exception on these types of things, up to as much as 50%, especially if they have to be liquidated for non-payment. Lenders do prefer tangible assets such as real estate that will not have to be discounted as much. Next slide. And then now that we've covered the 3 C's that I look at there's different types of loans that can be out there. And lenders will usually provide operating loans to farmers, and that, again, Kurt mentioned that earlier, annually based on their operations performance over the year. Those operating loans will follow the underwriting guidelines we've covered and usually be in the form of an open-ended line of credit. Open-end loans are those loans that can be paid down and then reborrowed against annually. The terms of repayment are normally quarterly or semi-annually interest. And then those are negotiable with when the farmer gets the income from their crops, or like when the vegetables come due, or when certain other enterprises get revenue from those enterprises. This is discussed with the borrower at the time of application when they get paid. Interest terms are usually variable and then tied to the current prime rate. And then the next slide will have closed-ended loans. And in some cases, lenders will elect to do a closed-ended note with a borrower if these funds will not be used for annual operating expenses. And I believe, again, Kurt went into a little bit of this earlier, what could be some closed-ended types of loans. But what we'll look at are farm real estate purchases, machinery purchases, and large supply purchases. Closed-ended loans will look just like an auto or truck loan with amortized monthly payment that is a fixed interest rate. Closed-ended notes may also have the need for collateral, depending upon the need for the funds. I know our credit union, Financial Partners, we're too small to do operating loans for farms and businesses, but we have the ability to work with an applicant that is going to be willing to pledge their home or maybe even a vehicle that's free and clear. And the funds are $50,000 or less. That's usually our benchmark from our federal regulator, the NCUA, of what we can book at in our what we call our retail loan sector. And in summary page, next slide. Each lending situation is different. In terms of operating loans will vary depending on the character, capacity, and capital of the applicant. And loans may be given that are closed-ended, one advance, or open-ended, multiple advances. Some FIs will partner with the Small Business Administration, and you saw some of Kurt and Marcus's slides with FSA and USDA as well. You'll need to consult with your lender if they offer any types of programs such as this. A lot of them will again partner with a local bank and then guarantee, we talked about guarantees earlier, to guarantee some of that debt. Lenders want the opportunity to help small businesses and smaller farming enterprises succeed. Yeah, I am hopeful that this information will help all of you with your operations. And then final slide has my contact information on it. So if any of you feel like the following, oh, my contact got covered there. Any of you feel like the following guy, where does all my money go? It's like hocus pocus on brocus. Feel free to give me a call or shoot me an email. I'm available to answer your questions, and I can at least try to guide you into the right direction. Be happy to do that. So with
Great.
that, I'll turn it back over to Tia.
Yeah, great. Thank you so much, Dave. We really appreciate all the information that you shared with us today. We do have a question in the chat. Is it the same case as with the USDA that you only loan for profit farms?
Yeah, we've got to have that. That's exactly right. I mean, we've got to have, there's rules and regs out there, and that goes with any federal financial institution as well.
Okay, great. And can you put your contact information in the chat? Actually, I think
there is. So I already did.
Yes.
All right.
Yeah, it's already in the chat. The last request we would have is, are you able to share your slides?
Oh, by all means, yes.
Awesome. Okay, you can get them to us, and then we will disperse them to our members here today.
Very good. I'll do that.
Okay, great. Thank you so much again, Dave.